Hi, how you doing? Ed Ross here with edsforecast.com. I wanted to tell you a little bit here about lenders, what they're doing, how they operate in economic times, how you can get financing, can't get financing, and different methods of getting financing ultimately to purchase real estate. First of all, everyone needs to understand that when a market is in a downturn, lenders do not give money away very easily. They make it very difficult. You have to have super high credit scores. You have to put large down payments down. They're really not happy with real estate investors because they're worried about their own portfolios and their foreclosures that they're having. So they tend to tighten the money supply. In fact, the greatest tightening of the money supply was during the 2008-9 timeframe and the crash. It has barely lightened up. It's been a several year process because of the Great Recession for real estate investors to get proper financing from banks. Now that is changing, and it's changing fairly quickly now. But the thing is that it's still probably about 5 years away from being fluid. Fluid meaning easier. Because when times are good, real estate is appreciating quickly. Foreclosures are down. Lenders then all want to fight for the lending business because they look good on their financials. They look good as a public company, and people buy more of their stock, and it goes up in value. So they will release the money supply become easier over time, and ultimately maybe become too easy, and that's when we have a downturn again. And the savings and loans happened in the late 80s, and then we know what happened with all the resales of loans and repackaging of loans and the hedging on loans that occurred before 2010. So we'll probably see a little bit more conservatism over the next decade or so, but at the same time, it will loosen and get lighter every year. Very slow process though, but every year it'll get a little looser, and probably a decade from now, it will be it'll contract again. So the good news is you will find it easier over time. So what does that mean? That means that if you have good credit, you have a good down payment, stable job, you're probably going to be able to get approximately 4 loans from a bank, possibly more if you go outside and go regional to regional banks for investing in properties that you want to hold. Um, if you have credit issues, if you have very low down payment, if you have issues that make it difficult for you to get a loan with a bank, then I would have to tell you that you have to find alternative sources. Now, there are alternative sources, and again, the alternative sources start to explode in the market as the market gets healthier. There are things what we call hard money lenders. Now, hard money lenders are those lenders that are could be institutions, but they typically are not doing like a Fannie Mae, Freddie Mac guaranteed, government guaranteed loan for your property. So the hard money lenders, I give you access to those and share many of those with you. What you do is you usually have to pay approximately, depending on how bad your credit is, and as long as the property has some good skin in it and some good value on it, then you'll pay anywhere from 3 percentage points higher than what you could get in a government secured loan from a local bank. So the 3 percentage points on real low interest rates that exist in the marketplace is not necessarily that bad, but you could pay as much as 5 percentage points higher. Now here's the good news. The good news is I don't really care if it's 2 points, 3 points, 4 points, 5 points, or even 8 points. What I care about is when you put that extra percentage on the note of the loan, how well are you going to do on making money on that property? Because there's nothing wrong with paying a higher interest rate if we know that your return on the interest on the property is going to be very high. And that's something for most average investors to calculate is very, very difficult, or they leave things out, or they under or overestimate their expenses or their incomes, and they just can't make it positive. I take that guesswork out for you, and I make it very simple for you to know exactly whether it's worth those 3 or 4 points. So don't be afraid to go with the more expensive interest rate if it works out financially for you for what you're going to be doing with the property over the next couple years period of time. Often I find that the higher interest rates are good and positive and smart moves for you to make on a portfolio. Now, hard money lenders are out there in the marketplace. Another avenue, which is probably the most popular in the market in recent years, is seller financing. Seller financing is you buy it from the seller carries a note for you, and you may pay them a little bit more of a premium. Again, you do that as the financial factor as you wrap into your purchase. And you still end up making a lot of money on the property, and the seller's happy because he's getting a good interest note from you. Seller financing is a very popular way of doing good times, bad times, almost any time in the real estate market. It's one that a lot of real estate investors use, most use, and it's a real good vehicle to learn how to become an expert in and understand all the avenues on it. There are other ways to finance, and I've done many of these creative ways. For instance, I had a property that I bought during the tough times, but I was going to subdivide the lot so I can have an extra lot to resell as land. Well, I did that, and I found out nobody wanted to buy land because no builders were building because it just wasn't a good time for the builders to come and buy land. So I was able to find a deal where I was able to sell the lot while I was purchasing a property from another person and make it a multiple exchange where they felt good because they had something they can hold for several years. I was able to exit out of the lot, and that was my down payment for me to purchase a really wonderful cash flow building that gave me approximately $1,500 to $2,000 a month income for the rest of my life, and I still have that building today. It's been one of the fantastic purchases I did with that creative financing. There's many other creative financing ways to do things like wraparound trust deeds, where you assume or you can assume someone else's note. There's probably about 6 or 7 different methods that I share with you, all of them that you become proficient on and experts at, and definitely something that is really worthwhile as a real estate investor to pursue and think about. So lots of creative ways to get money out there, lots of creative ways to be a real estate investor and find financing regardless of where you sit from a credit standpoint. It just may make it a little more difficult if you have no credit and you have no cash, but there's lots of ways to pull this together.